Hey guys, this is Andrew for TRENDLINES.com. So I've been working as a professional trader on the option market for the past 6 years in Hong Kong, and I've decided a few months ago to create my YouTube channel because I want to share with you all the different things that I see at work, and I want to show you how to do it yourself. So basically how to make money on the markets, because this is what we are doing as traders. And I want to bring you a bit more into my words. So I mostly talk about technical analysis, but I want to start talking with you about options, because those instruments can be very, very useful to build up very nice and profitable strategies. So let's get into it. In today's video, guys, I want to show you the difference between your position, which is buying Gamestop shares. All right, so say you have 100 shares, I know 100 shares is a lot, but we can take 10, but it doesn't, look the same. So let's keep 100. And the good thing is that the multiplier on the option is 100. So, it makes it easy to compare. So you have 100 shares, your P&L is something like this. Basically, if GameStop goes to 800, which I think we might see this year, you're making 60,000 US dollars. But you have some downside risk because your position is a Delta 1 position. You are long the stock, so you can lose everything. You can lose your notional. Your notional is 60,000 US dollars. Instead of that, there is a strategy that is very used in finance. I use it a lot. I mean, it's a very, very common structure that we trade with very big sizes every day on every share, every index. It's called a risky. So what is a risky? A risky is a strategy that consists of selling a put and buying a call. So let's say now you don't have any shares. Buying a call, you know what it is, because you guys like to buy calls. So you have this payoff. So for example, you buy a 300 call because you are convinced that GameStop would be trading above 300 in July. I'm doing everything on the July maturity. But now you can also sell a put, guys. And I know that a lot of you are doing this. Retail investors are selling more puts than they used to before, because they noticed that it's actually a very nice trade to make. It's like, usually professionals are selling options and retail is buying options, but we've seen the flows are changing. A lot of retail investors are now starting to actually sell options, which is, let's be honest, the smart thing to do on the long term. All right, selling those options is actually more profitable on the long term than buying them. This is why professionals are selling them, and you guys can sell them too. You just need to know what to do. And here you go back to your chart and you need to find some levels that you are confident we won't be trading below. You don't choose your options randomly. You need to find levels where you think that GameStop is not going to be traded below. So for example, 50 is one of them, but 50 is too low, and 110 is my support level here, is one of them too. So you can do it with 110. So you go on Yahoo Finance and you check 110 option price, it's worth 19.5. So this one is useless, we don't use it, guys. I put a 0 here, and we're gonna sell a put, strike 100, and you sell one contract, so 100 options. All right, and the price is we said 17.5. all right, so now you can see that basically you sell a put so that your call is free. And the beauty about that is that basically you can see your payoff. So only the put is something like this. So the put makes you lose money below 100 because you're selling it, and the call is making you money above 300. So right now, let's say you do 1.2, it's not changing much, it's still zero cost risky, and you are actually able to capture the same upside performance, $60,000 to the 800 strike as you used to with your shares, but your downside risk is lower. You can see that not only you losing only 12,000 if we go to 0, which is less than 60,000 with your 100 shares, but most importantly, you don't lose everything if your scenario is correct. What was your scenario? Let me remind you guys. Your scenario is that we won't be trading below 110. All right, this is my scenario. but I don't think we will be trading below 110 in July. I think 110 is going to hold. Of course, I might be wrong. If I'm wrong, then I take a loss by doing this strategy. But this is how you combine technical analysis, support levels, resistance levels with the option strategy. And once you combine those two, you can build some very efficient strategies, option strategies that can actually help you to realize the same gains for lower risk. Because here, if GameStop trades at 125 or even at 100, you're not losing money. And this is a scenario that you consider is possible. So you don't want to lose money in this scenario. So instead of having shares, you have a risky. Once again, this is my risky payoff. So max, I lose 12. Between 100 and 300, nothing happens. And above 300, I have the same payoff as I had with my shares. It's slightly different, but it converges to the same payoff, 60,000. So that's it for me. I just wanted to show you guys that you can use options to replicate almost the same payoff you would have by buying shares, but you can modify your risk configuration. And you can combine this with technical analysis so that you build some strategies that fit what you think might happen in the future. So guys, that's it for me. I hope you enjoyed this video. And if you did, please don't forget to click on the sub, like, and bell button so you're going to be the first to know when I upload anything new. And stay close to shore. I'll see you guys.